Welcome to Trading Day. I'm Andrew Bell. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Canada's economy shrank at the end of last year. StatsCan says gross domestic product fell 0.6% in the fourth quarter, led by a sharp decline in business inventories. The decline was partially offset by increased household spending and exports. For 2025 as a whole, GDP increased just 1.7%, the slowest pace of annual growth since 2020. We got some insight on what the data might mean for the Bank of Canada.
That's 2 quarters out of the year where we saw the economy contract. Back in the second quarter, obviously, because of the trade war. But it does appear that ongoing uncertainty about trade policies continuing to weigh on business investment. This number is a little weaker than the bank was anticipating, but not weak enough to spur another rate cut. I think unless the economy shows more sustained weakness or the labor market shows sustained weakness, I doubt very much the Bank of Canada is inclined to cut rates.
China will begin halting tariffs on some Canadian agricultural goods starting next week. Beijing will suspend the duties on Canadian canola meal and pea imports, as well as lobster and crab. The move comes after Prime Minister Mark Carney's visit to China last month and is in exchange for Canada cutting tariffs on Chinese electric vehicles. Shares in Atkins Realis down about 3%. The engineering firm provided a full-year forecast for profit and cash from operating activities that fell short of some analyst expectations, disappointing investors. Some analysts are also noting a higher-than-expected lump sum project loss, as well as a miss on capital revenue. However, Atkins says demand for its services and nuclear products remains strong, leading to a record-high backlog. Shares in BCE up about 2%. The telecom giant is investing $1 million in the McKenna Institute of the University of New Brunswick. It's a move aimed at strengthening Canada's digital economy and security. The money will be used for cybersecurity education and skills development and will utilize AI to support next-generation cyber defense. BCE is the parent company of BNN Bloomberg through its Bell Media division. And the TSX finishing February on a down note, although it did close at a record high yesterday. And let's check out the U.S. markets. And they, too, are drifting down. They've had a choppy week. Investors weren't thrilled with the NVIDIA results on a Wednesday. And we did see selling in chip stocks. So we're ending February on a down note. Worries are hanging over the market about AI disruption and massive tech spending on things like server farms and data centers. We also, of course, have geopolitical tension amid speculation that the U.S. will launch an attack on Iran in order to pressure that nation to curtail its nuclear program. We're joined by Chad Larson, Senior Portfolio Manager with MLD Wealth at CG Wealth Management. It's great to see you. Thanks very much indeed.
Pleasure having me.
So the U.S. economy, U.S. market is still bare, or as of today, was barely up in 2026. And I was amazed earlier this morning when I checked the Mag 7 stocks, all of them were down at least a bit this year.
Yeah, and I think, I was here a few weeks ago and, everyone's talking about a rotational trade that's happening. So, yeah, the market's seeming to go up-ish, but the leadership is looking to rotate. Even with NVIDIA's earnings, they were a beat. They exceeded expectations, and the market still traded them down. I think you have these. We've been talking about a crowded tech trade for a very long time, and expecting the same thing to do the same thing over a period of time will catch people off guard. And so you're just seeing people not fatiguing from them, but where else can they go from here? So a lot of sector rotation continues to kind of be the thematic that we see in the market.
Right. What areas of the market do you think investors will be exploring from now?
Well, we're seeing it. Like we're looking
Yeah.
at the Dow, keeps trying to inch its way higher. Doesn't look to be tech leadership driving. It was the Mag 7 that took us all to the promised land for the last number of years. And so it's sector rotation. You're seeing that into the industrials. The materials have obviously led the way. Oil's been creeping higher. But more than anything, when we see some of the earnings coming out, more than anything, it's guidance is driving the market value. Good results are good results, but they're expected now, and we're starting to see people rotate for predictable, stable cash flows. Boring is beautiful again. And I think, to jump in, you did talk about we are experiencing heightened volatility. You're starting to see the VIX bounce around intraday and really start to whipsaw people's emotions. We've seen the largest mobilization of a military force since 2003 into the Gulf. That is significant. Obviously, some geopolitical pricing coming into oil, but that bodes well for Canada. It's a resource market. Gold, energy, international equities continue to catch a bid from stability, and the gold complex looks great.
When clients talk to you, do they say, look, I've made money in tech stocks, those that have held them, but are they getting nervous?
They absolutely are. And I think it's interesting, we're in the early front part of the calendar year. As people were already contemplating these large embedded gains in their portfolio into the end of the year, everyone kind of wanted to wait into the new year, at least kind of slow down the tax man at least a year until they had to come back to collect, so to speak. But I think so often when something's worked so well for you for so long, saying goodbye to it is hard. So it's a really reframing of how people's emotions are positioned through this. But there are nervousness. Calls are nervous.
But of course, a classic mistake is selling your winners.
Yeah. I love that you said that. I think a lot of investors are very guilty of cutting their flowers and watering their weeds. It feels really good.
Like that,
it feels really good and responsive to say you did something good and that you took a profit. But good things can compound. An investment thesis doesn't change because of price action. And I think a lot of times people are very much guilty of hanging on to their losers or selling their winners too quickly.
What about Canadian banks as a group? Can you comment on them? Do you like their prospects?
Yeah, I think I can comment to them with respect to they're the bellwether of the Canadian economy. I wouldn't, purport to get into. We saw RBC report. It was a fantastic print. Reading through that, we saw loan loss provisions are in line. Mortgages are staying okay. I wouldn't say it's not super healthy, but it's not super sick.
Maybe we can put up a 5-year chart for the Canadian bank index. I mean, not too long ago, it was hitting record highs, and it's near record highs.
Yeah.
We are seeing generally selling across a lot of stocks today.
Absolutely. I think the 5-year chart looks great, but again, where do we come into this today? I think there's general concern in the housing market in Canada, and banks are obviously that bellwether to the economy.
Yeah, it's quite a drop actually today, isn't it? 2%. But from near record highs.
The further you step away from any chart, it gets pretty. It looks nice, but and we're seeing a lot of those. A lot of the calls that are coming in is looking at at the stocks. Looking at software companies as this transition away from AI. Is it going to be the eater of software? It's some bumps along the way for sure.
Yeah. What is your view on energy stocks? Are you overweight, underweight? Can you generalize?
Yeah, I can. Listen, we've even seen through, obviously recently with the price action of Brent crude hitting all-time highs because of geopolitical uncertainty in Iran, you saw energy stocks doing better even when oil was down low. I think there's a move for scarcity. I think if you look at Dave Zabunka at Canoe does a really incredible job at framing this thesis. You're seeing less and less commodity owned by fewer and fewer. We're seeing almost like an oligopoly set up where companies are getting very big and there's a scarcity. There's singular companies now are controlling massive parts of resource, and that bodes well for the industry as a whole. We're seeing private equity active in the space. We're seeing M&A happen in the space. So I would say we're bullish the energy equities, but near term, volatility in the commodity price.
As you say, the oil sands have been consolidated, partly because foreign oil companies have pulled out.
Yeah. Yeah, there's just, I think in this modern time, a lot of them are look to be maybe even re-rated. These are flagship legacy assets that would probably, they won't be discovered again. And a lot of them have reserve lives like upwards of 90 years.
Yeah.
The conventional, wisdom, I've been doing this over 22 years, trading at a multiple of cash flow 5 or 6 times. When you have assets that are 90 years in length, that's a whole different ballgame.
The economics are completely different.
They're forever assets.
Chad, thanks very much.
Pleasure.
Chad Larson, Senior Portfolio Manager at MLD Wealth at CG Wealth Management. In a speech to the Economic Club of Canada, the Conservative leader, Pierre Poilievre, shared his vision for Canada-US relations, and he also took aim at US President Donald Trump. We'll have more after the break. We got dueling speeches yesterday from 2 key political figures. The Conservative leader, Pierre Poilievre, shared his vision for Canada-US relations and took aim at US President Donald Trump. Meanwhile, Dominic LeBlanc, who's the Minister for Canada-US Trade, gave a rare update on the talks between the two nations. CTV's senior political correspondent Mike Le Couture filed this report.
What President Trump says about Canada is wrong.
It's the strongest language Pierre Poilievre has used against the U.S. president to date. In a speech to the Economic Club of Canada, the Conservative leader laid out how he would deal with the American administration if he was leading Canada. He also took a shot at Prime Minister Carney's assessment of the global trading system.
We should not declare a permanent rupture with our biggest customer and closest neighbor in favor of a strategic partnership for a new world order with Beijing.
Poilievre told the Bay Street crowd he wants to negotiate a new tariff-free auto pact with the U.S., an end to sectoral tariffs, the revival of the Keystone XL pipeline, and a full exemption from Buy American provisions.
I think that Canadians are expecting on this an existential issue for many Canadians, a signal from the opposition leader that he has some solutions.
While Poilievre was offering his remedies for the issues with our ally, the minister responsible for trade with the U.S. was giving his own update on negotiations and setting expectations for hard-hit industries like steel, aluminum, lumber, and autos.
But those will be bilateral arrangements. Sort of adjacent to would be the bureaucratic phrase, the trilateral trade agreement.
While Poilievre has proposed a cross-partisan team to help with the CUSMA review, it's unclear if the government will accept the offer. Meantime, Minister LeBlanc confirms he will meet with U.S. Trade Representative Jamieson Greer in D.C. next week.
Up next, Chartwell Retirement Residences posting the first distribution increase since 2020. We'll find out how it's managing to fill up its facilities. We'll be right back. Chartwell Retirement Residences posting fourth quarter numbers, and good news perhaps for investors, the first distribution increase since 2019. Of course, the industry was disrupted by COVID. We're joined now by the CEO, Vlad Volodarsky. Thanks very much for joining us right here in person.
My pleasure.
So tell us about the quarter, your occupancy, something like 95%?
It's been the record year for Chartwell on all kinds of metrics. Our occupancy increased by 480 basis points during the year, reaching 95.2% in our same property portfolio in December.
And let's put up a 5-year chart for your stock, because I was just looking. The low point, I guess, for occupancy was in 2021. If we put up, there's a 5-year chart. You got down to, wow, below 80% at one point.
It was nearly 76%, yes.
Right. And wow. So the business is booming. I guess you got demographics on your side.
Absolutely, we do. Clearly, post-COVID recovery has been thankfully robust. We do have environment that's never been as attractive as it is today to be in senior housing, where the demand is growing by between 4 and 5% annually. And we had now 4, almost 5 years of very little new construction starts. And so we have this dynamic of growing demand where there is virtually no new supply coming in.
I think we've talked about that before, the enormous cost of construction in Canada right now.
Yes, and things are improving, both on the cost of construction side and clearly with the successes that all operators have in this environment. We think that there's going to be some construction starts in 2026. We already have 2 projects in construction in Quebec and 1 in development in Alberta with our partners. And we think we're going to start a few more in 2026. Clearly, there is need for more suites to be added.
So I was just looking here, your revenue per occupied suite up 4% to just over $5,000.26. So that's an average. It varies, though, across the country.
It varies across the country. It varies across different service levels. Our portfolio is anywhere from independent living to assisted living and memory care. So people who require less services pay lower prices, and people who take up more services pay higher prices. Generally, in Quebec, rates are lower because the model is more of an a la carte, where people, when they join us, they pay just rent, and meals are not included. They might have monthly housekeeping included in that rent. And then as their need progress, they can add on meals or care services on an a la carte basis. In the rest of the country, the model is more of an all-inclusive, where meals usually and some of the support services would be included in the base rent and services price.
So if you can generalize, a single person could get a suite with all meals for $5,000 a month?
With meals, yes.
With meals. $60,000 a year. Yeah, but the cost of living these days, I mean, everything is expensive these days. And I'm just if a couple moves in, they're not paying twice that, though.
They're not. They're paying for the services that the second person's consumed. And when people talk about $60,000, it does sound like a large amount of money. There's also cost of living at home that people don't often realize exist. Where often our customer has mortgages paid off, and they perceive that living in their home is virtually free, which is not true, of course.
Taxes, repairs, you name it.
Meals.
Yeah, meals. I know. Yeah. Oh, I like the idea of having everything done for me, I must say. What is the typical age that people come in? Can you, or what is the sweet spot that you start really getting people?
It's about 80 years old, low 80s.
That old. That's interesting. People generally hang on in their houses through their 70s.
Generally, yes. And nowadays, people are healthier and living longer. And so it's understandable that by the time they make decision that they need some support or they do not want to keep maintaining their residence, at that point in time, usually people make decisions to move.
I'm ready to stop maintaining my residence now, especially with this winter and shoveling all that snow.
I'll leave you my business card.
Okay. First time you've increased the distribution since 2019.
That's correct. We started distribution increases back in 2014 when we felt that we have solid financial footing and the business was progressing very well, and we maintained modest distribution increase pace from 2014 until 2020, when, of course, pandemic happened. And we made what was a difficult choice at that time to maintain the current level of distributions all the way through pandemic. And now we feel that we're in the position that we can start, again, distribution increases, and our intent is to continue to do this on an annual basis as our earnings continue to grow.
Your debt to EBITDA, it looks high at around 6.9 times. Can you put some color on that?
Not in the real estate context. So in the Canadian real estate context, 6.9 debt to EBITDA ratio would be on the lower end across all the REIT universe. So generally, on average, it'll be probably close to 9, and we're now at 6.9. Our target is to maintain net debt to EBITDA under 7.5 times.
What is your credit rating? Is it investment grade?
It's a BBB low with positive outlook, so hopefully with some hope of upgrade.
Yeah. And what is your plan now on the distribution? Do you hope to increase it every year, or?
Absolutely. The intent is to continue modest distribution increases and sharing the growth in the cash flow with our unit holders. We also balance it against the opportunities to deploy capital within our business to acquire newer, higher quality properties and towards our development activities.
So places come up for sale. You don't always have to build them yourself.
Yeah, we've been very successful in the last several years. Just in 2025, we closed or announced $1.7 billion worth of acquisitions of higher new properties, and we expect to continue to do that going forward.
Thanks very much.
My pleasure.
Vlad Volodarsky is the CEO of Chartwell Retirement. Okay, we have lots more coming up on trading day. The U.S. Supreme Court handed President Donald Trump a setback on his tariffs today. We'll have more when we return. The Supreme Court decision this week in the United States blocking President Trump's tariff strategy, or a big part of it, has thrown U.S. trade policy into turmoil. As Trump scrambles for a new path, Bloomberg Originals looks at what his trade war has accomplished.
For President Donald Trump, few things appear to matter more than
tariffs.
Tariffs.
Reciprocal tariffs.
A lot of tariffs.
The most beautiful word in the dictionary is tariff.
Now his signature policy has hit a roadblock.
Trump's biggest legal defeat since returning to the White House.
The Supreme Court striking down President Trump's tariffs.
It's a major blow to President Trump's economic agenda.
2/3 of the tariffs that President Trump implemented in 2025 have essentially been ruled illegal.
That really has taken away one of the main ways in which President Trump has disrupted the global economy.
But Trump says he isn't backing down.
Today I will sign an order to impose a 10% global tariff under Section 122.
A day later, he upped the ante, saying he'll raise that rate to 15%. But these can only stay in place for a maximum of 150 days.
What he is going to have to do now, instead, is use tariff authorities that are much narrower and in which he really has to prove an economic case for the need for them.
For US trading partners around the world, it's causing tariff whiplash all over again.
The EU was the quickest to react so far. They have moved to freeze the implementation of their side of the trade deal that was signed with the US. There are a few countries that actually stand to lose despite facing lower tariffs now than before the ruling. So countries like Vietnam, what they've lost is the comparative advantage that they had relative to China. China is probably the biggest winner from this ruling.
Almost all countries and corporations want to keep the deal that they already made.
So, how will this affect businesses and consumers, or the trajectory of Trump's remaining 3 years? And what happens when the 150 days are over?
We have maximum uncertainty over where trade policy goes from here.
This wasn't a battle before the Supreme Court between President Trump and China or a faceless corporation. The main plaintiffs who challenged these tariffs were a toy company, Learning Resources, and a whole coalition of other small businesses who really felt like President Trump and his tariffs were an existential threat to their businesses.
At the centre of the fight was a law called the International Emergency Economic Powers Act, IEEPA. It allows a president to regulate some aspects of commerce after declaring a national emergency.
Trump claimed that it gave him the power to immediately put a tariff of any level on goods from anywhere. And the Supreme Court ruled that just wasn't the case.
What the court didn't make clear is what happens to the money already collected.
Essentially, the Supreme Court ruled that the U.S. collected $170 billion in tariffs unconstitutionally.
Trump himself has indicated that this is going to take years of litigation to calculate and distribute refunds.
There is the possibility that it could just be a very clean process. The Customs and Border Protection knows who paid the tariffs and knows how to refund them.
There have been episodes where tariffs have been refunded in the past. That's not unprecedented, that's not unheard of. But the scale of this, I think, is unprecedented.
Think of it as the mother of all tax refunds.
Trump had promised that foreign countries would be the ones paying for his tariffs. But
as it turns out, the foreign exporters aren't eating the tariffs. they're 90-95% pass through to U.S. importers and their customers.
Reducing the US trade deficit was one of Trump's stated goals with tariffs, but in truth, they've barely moved the needle.
The United States last year in 2025 had a trade deficit in goods of around $1.2 trillion. It was almost exactly the same size as the trade deficit that it had in 2024.
The main impact we saw from the tariffs was to reshuffle trade away from China and towards Mexico and other Asian countries, more than reducing the aggregate trade deficit.
And so far, Trump's trade policies have failed to deliver on another long-held promise: rekindling US manufacturing.
Trade policies will return significant manufacturing jobs to our country.
The problem so far for President Trump is that 10 years on, the situation in manufacturing doesn't look that much better. In fact, in the last year, the U.S. lost more than 80,000 manufacturing jobs. That's even as these tariffs went into place. A lot of manufacturers rely on imported components, and if those imported components and big things that they use like steel and aluminum are more expensive as a result of tariffs, they can't hire more people. They can't grow. The costs are just higher.
More tellingly, if we separate that industrial production into industries that faced higher than average tariffs and lower than average tariffs, we see that any growth that was there was really driven by the lower tariffed industries, things like pharmaceuticals, electronics. Whereas the higher tariffed industries, think autos and metal sectors, faced much slower production growth.
Manufacturing is no longer going to be a big source of employment. The jobs that have gone, most of those jobs are not coming back. The principal driver of that trend is not trade, it's technology.
But it's Trump's foreign policy, not domestic, that now may need to change the most.
The biggest blow to Trump from this Supreme Court decision is really how it hits his ability to shape geopolitics in the world. He's used tariffs to threaten India and its purchase of Russian oil.
They will not be buying oil from Russia.
He's used the threat of tariffs to also interfere in domestic politics, like in Brazil. Those are all things he was able to do because of this authority he claimed that gave him this kind of immediate ability to increase his leverage, to apply pressure on other countries.
But that may have backfired.
I don't think there's anything wrong by any means with an American president seeking American advantage. That's the job. The question is, are these methods working? So if you think of Europe, if you think of Canada in particular, governments are weak in many ways in relation to the US. The demands that the US is making are so off the charts in terms of their previous experience. I think they're struggling to process it. You know, can we rely on the US commitment in NATO? And the controversy that followed the president's demands about Greenland.
We want a piece of ice for world protection.
There were Europeans who were actually wondering whether at some point European soldiers would be fighting US soldiers. Extraordinary.
All of this is happening in the run-up to the US midterm elections.
Poll after poll shows that these tariffs are incredibly unpopular and that people associate them with this broader issue of affordability. It's just another way that they see the government making life harder, raising prices.
Republicans should be asking themselves if they want to keep backing this policy, which is just meeting obstacle after obstacle when it comes to implementation.
Trump wants Republicans to win the midterm elections. It's going to be harder for them to do so if a lot of voters don't like his signature economic policy.
And it's something the Republican Party can't ignore, since Congress has to approve extending tariffs once these first 150 days are up. A budget reckoning is looming, exacerbated by the possibility of the government issuing tariff refunds.
One of the big issues going forward is going to be the fiscal implications. Huge sums of money are involved. And if that goes away because of refunds, then that's a new hole in the budget deficit outlook.
One of the major policies implemented last year was the continuation of tax cuts and other expansionary fiscal policies that would otherwise raise the fiscal deficit, and the administration was really counting on this revenue from the tariffs to plug that fiscal hole and finance the fiscal deficit.
But even with tariffs, the numbers don't add up. With the exception of the Clinton era, the US has been running deficits steadily. The pandemic required massive government spending, and the tariffs introduced since Trump's first term have made a dent. But the trend is the same, with the annual deficit still hovering near $2 trillion.
The public debt was on track to keep increasing in relation to the size of the economy. If you take the tariffs away, that fiscal gap gets very much bigger. Then the question becomes, is the bond market going to be okay with that?
The bigger worry is this growing sense of unease about the United States, and that erodes over time the power of the dollar as the world's great reserve currency, and that essentially investors around the world slowly lose confidence in the United States.
That loss of confidence is being fueled by Trump's disdain for some of the institutions behind America's perceived strength, like the Federal Reserve and now the Supreme Court.
This isn't the last time the Supreme Court is going to weigh in on President Trump's use of presidential powers or his invocation of emergency powers. This is the beginning of a broader potential conflict that has enormous ramifications for the United States, its governance, the state of democracy, and the Constitution.
Trading Day, we'll be right back. On Hot Picks today, we looked at two players in farm inputs, farm chemicals, and also a broader base chemical player. Our guest was Seth Goldstein, senior equity analyst at Morningstar. We kicked things off with Corteva, his top selection. It actually plans to separate its crop and seed businesses.
Corteva is one of the leading patented seed and crop protection chemical companies in the world. And so these are the essential products that farmers need to grow crops and protect crops from insects, weeds, and fungus pests. And so Corteva's leading portfolio of intellectual property really creates value for farmers because it allows farmers to grow higher yields with their crops. And many farmers turn to Corteva for their seeds and chemicals. Even when crop prices are low, they still pay up for Corteva's products.
And why are they spinning off the seeds business?
Well, they see two divergent growth paths for the seeds and the crop protection business, and they want to allow each to be fully funded and grow independently of one another versus having to, say, in the crop protection business, develop products exclusively for the seeds business. Now the crop protection business can focus on developing the products it thinks will be the best value for farmers. And so they see a good spinoff right now. Corteva has a very strong balance sheet, net cash position, and really this is going to be two leading companies instead of one, both a seeds leader and a crop protection leader post spinoff.
The stock has been doing well. Is it a cyclical name in the sense that it rises and falls with crop prices?
Not as much. For agriculture, it's very cyclical based on crop prices, but for Corteva, they're a little less cyclical versus other ag companies because the seeds business tends to do well based on Corteva's new seed development and how they do versus rivals such as Bayer versus just rising or falling with general crop prices.
Mosaic, a giant fertilizer company, huge phosphate franchise. They're in the other crop nutrients, though, as well. Why do you like the look of this one?
Well, Mosaic has had some company-specific issues at both its potash and phosphate mines over the past year, and this has really led to higher unit production costs. We have seen phosphate prices fall slightly for the start of the year, but we expect prices will stabilize in the low $600 per metric ton range. We think potash prices will remain in the mid $350 per metric ton range, and longer term, as Mosaic produces more potash from its low-cost Esterhazy mine, and as Mosaic is restoring its phosphate production, we expect unit production costs will fall and profits will grow, generating positive free cash flow for Mosaic, whereas the current results don't reflect where we think they can get to under mid-cycle conditions.
Sorry, just remind us, what problems have they had over the past couple of years?
Yeah, they've really had some long-term mine issues, both their phosphate mines in Florida and their Canadian potash mines, and they've really had some challenging production issues. They've been trying to ramp up these productions. In Florida, they've also had some storm damage impact some of their mines in recent years, and so really they've had to spend a lot of extra costs over the past year and into this year to really make sure that the long-term health of these mines is set up so that they can ramp up production. And in the meantime, this has created some higher near-term costs. And I think the market's extrapolating this to assume it goes on longer than we think it will.
Eastman Chemical, now they were affected by the U.S. Supreme Court decision against some of President Trump's tariffs. Tell us how that played out.
Yeah, so President Trump, after the U.S. Supreme Court came out and said the tariffs were illegal and unconstitutional, President Trump said the tariffs will go ahead. And this really hurt Eastman and all chemical stocks because for Eastman, they sell a lot of specialty chemicals to companies that make consumer products that are then exported to the U.S. And so there's really big secondary demand impact and secondary impact of the tariffs from Eastman due to lower demand from their customers. And really what we've seen is this has caused chemicals, which is already seeing bottom of the cycle type of demand. The bottom of the cycle conditions just continue and will continue into 2026. But the good news for Eastman is they have a good balance sheet. They generated free cash flow last year exceeding dividends, so we don't see the dividend as at risk like some of their chemicals peers that have had to cut their dividend. And Eastman is well positioned for a recovery. So when we see the eventual demand recovery, we think Eastman will see profits snap back in quickly short order because their specialty materials are essential to their customers and just tend to work better than their customers, which gives them very strong pricing power.
And what about the dividend? Is that one reason why investors buy this stock?
It is. Right now, you get a really high dividend yield, and you don't have to worry about it being in jeopardy versus, Dow, Lyondell, Celanese have all had to cut their dividends over the past year due to not generating enough positive free cash flow or high debt levels. Eastman has a better balance sheet. Eastman generated free cash flow above dividends. And so we see the dividend as very safe, and essentially investors can collect the dividend and wait for the chemical cycle to recover.
Still ahead, one of our favorite spots of the week. We'll check in with Bloomberg Canadian finance reporter Christine Dobby. We'll find out what's in her newsletter this week. Let's check in with Bloomberg Canadian finance reporter Christine Dobby, who writes Bay Street Edition, a weekly newsletter covering all the latest in Canadian finance. Thanks very much indeed for joining us. As predicted, you came out with this. The emphasis for bank investors has switched from PCLs, possible credit losses, to ROE. Tell us what we learned this week about bank profitability.
Hi, Andy. Yes, I mean, this week was all about return on equity at Canada's big six banks. They all beat analyst expectations, and instead of, as you said, this focus on credit losses or provisions for potential credit losses, which had really dominated the narrative for a couple of years there, the focus has really shifted to credit being a lot more stable, and so. Investors are looking for the banks that can show the best return on shareholders' capital. We saw all of the banks make improvements on their ROE quarter over quarter. And some of them made some big improvements, including CIBC, which was at the top 300 basis points of improvement there. And they got a share price boost in return for that. I'm sorry, I'm very tired this week, so words aren't coming to me that easily.
With your bank earnings, you must. Yeah. You know what? I'm doing bridge lessons, and it's everybody else in the class is well ahead of me. Anyway, Paul Bagnall is there too, and he said to me this week, I miss reporting on the banks, and he used to love that. Christine, go on. Sorry.
No, he was always so good. He just knew every detail of every bank. I was always blown away by him. But yes, it was in general a very good week for the big Canadian banks. They and on top of just beating EPS estimates, they really had strong revenue growth across pretty much all of their divisions. Capital markets continued to be fueled by a lot of trading activity. Wealth management saw fee revenue boosts from asset appreciation, and the Canadian retail businesses were doing pretty well on top of that. So a very solid quarter for the banks.
And the stocks are down today, but the banking index hit a record high yesterday. Yeah, the market's weak. Interesting. You guys broke this story about a possible IPO from Apotex, the generic drug maker whose founder, Barry Sherman, of course, was killed a few years ago. But we could see a return of IPOs to Toronto?
That's right. Yes, myself and my colleague Paula Sambo, we broke that news earlier this week. This could be a really significant IPO debut on the Toronto Stock Exchange. The people that we spoke with were telling us that they're seeking up to $1 billion to raise up to $1 billion. So that would be a fairly sizable IPO. And there's really been a dearth of debuts of that size for the past few years. So there is some hope amongst investment bankers that this is part of a broader trend, and that we will be seeing some more activity of that kind as the year goes on.
It's interesting, just very quickly, the Financial Post has a good story looking at these Canadian special acquisition corporations, a kind of a cut price way to go public. Apparently, they've been a disaster for investors in Canada. Not one of them, according to a prof at the University of Calgary, is trading above its deal price.
Wow. Yeah. I mean, it's really just been a kind of a bleak few years for investors looking for new firms to invest in, and this SPAC boom has really not turned out so well for many people. So I think to have a couple of big name IPOs go well would really be a boost for markets.
Have you ever tried bridge, Christine? Have you ever taken it on?
I'm not saying anything by this, but my mother is an avid bridge player and does take lessons all the time.
Does she play online?
She plays online and in person. It was something she picked up during the pandemic. It's a complicated game. She's got several books on it.
Oh, you're telling me. My wife and I say we're going to have to get these laminated sheets and lay them out on the table, because there's so many rules and unbelievable. Good for the old brain cells.
I was going to say, I think it's very good for the brain. Keep it up.
Yeah, I'll try. But just as I say, everybody else in the class seems to be ahead of me. And I'm like, anyway, thank you very much, Christine. Have a good one. And get some well-deserved rest after that tsunami of bank earnings this week. Christine Dobby.
I'm going to go have a nap.
Thanks a million. Bloomberg's Christine Dobby, her weekly newsletter is called Bay Street Edition. You can sign up for it by going to bloomberg.com/newsletters. Thank you very much indeed for watching for our show today. Do we have a quick time to have a very quick look at the markets? Maybe not. They're down, but remember the TSX closed at a record high yesterday, so we really can't complain that much. Thanks very much for watching the show once again, and have a great weekend.